What's up, guys? Bang, bang. This past week saw tons of chaos and uncertainty in the traditional financial system, and also, of course, Bitcoin responding as well. First, let's start with the Federal Reserve. The Fed is in control, and the old adage, don't fight the Fed, is as true today as it's ever been. The Fed hiked interest rates by 0.25%. That is the 9th straight interest rate hike over the last year or so. Over the last year, we have seen the Fed dump about $1 trillion off their balance sheet, and they've hiked interest rates to 5%. But even though they continue to create tighter and tighter financial conditions, the official inflation metric has not dropped below 6%. That causes major issues because every economic data point is pretty much telling the Fed to continue to create tighter financial conditions, continue to hike interest rates, and continue to conduct quantitative tightening. But while they do that, the banks are in crisis. We have seen multiple banks in the United States, from Silvergate, Silicon Valley Bank, Signature Bank, and First Republic Bank, all come under massive stress and have to be bailed out either by the government or by the private market. But that banking crisis is not just here in the United States. We also have seen the virus spread into Europe. First, Credit Suisse was a victim and eventually was sold off, and also all bondholders were wiped out. But now, Deutsche Bank seeing their credit default swaps drastically increase in price, which signals that there may be trouble ahead for one of Europe's largest banks. Now, as we look at what's going to be the solution, the government is stepping in, both here in the United States and abroad. We saw the Swiss National Bank step in and provide liquidity to Credit Suisse, but now Deutsche Bank may need the same. Back domestically, the Federal Reserve, the FDIC, and other organizations are throwing monetary bazookas at these banks. We have seen them step in with both the Fed discount window and also the federal program for bank lending that was recently set up. The banks are pulling hundreds of billions of dollars of liquidity from these programs. And on top of that, we've seen the Fed's balance sheet increase by about $400 billion in the last 2 weeks. To put that $400 billion increase on the Fed's balance sheet into perspective, the Fed has given back about 64% of all progress they made in quantitative tightening over the last year. There are stairs on the way down, but there's an elevator on the way up when it comes to the Fed's balance sheet. Now, as the Fed continues to step in and provide more liquidity, and they continue to increase their balance sheet, you can think of what's going on as the Fed has one foot on the brake and the other foot on the gas, and they're confusing the car. Because while they continue to raise interest rates, they're providing all that liquidity, and the market doesn't exactly know what to do. But the market is looking at those interest rate increases as something that will be a thing of the past in short order. The market is pricing in multiple interest rate cuts before the end of 2023, which would be a full-on pivot back to loose monetary policy, both quantitative easing and a drop in interest rates coming from the Federal Reserve. Now, as this occurs, we are seeing two impacts that relate to Bitcoin. The first is there is a psychological awakening that's occurring in the Bitcoin world. More and more people are realizing that their money sitting inside some of these banks may not be as safe as they previously thought. They have questions about the debt in the United States, which the debt to GDP ratio increased from about 62% back in 2007 all the way up to 129% today. If the debt to GDP ratio in the United States has doubled since the last financial crisis, we must remember that we are weaker when we get into this new crisis. And so naturally, people start to question, what are the alternatives? Bitcoin is one of those solutions, and we have seen Bitcoin come flying out to start the year, up about 60% or so. But there are other alternatives that people will turn to, including gold, real estate, and others. I personally prefer Bitcoin, but to each their own. Now, one of the key components of the current financial crisis that's worth calling out, which will have a positive impact for Bitcoin, is that the deposits that are fleeing these banks, causing all this stress, is not just coming from bank runs. Yes, the bank runs do have a negative impact, but also many investors are merely moving their US dollar deposits into money market funds and other types of assets where they can generate a higher yield. Whether people are moving deposit money because they want to withdraw from the bank or they simply are moving it into non-deposit accounts, it puts the banks under stress. Anytime you see swap lines between the major global central banks all being used heavily, it tells you that people are under stress And the central banks want to make sure that they try to prevent and mitigate any future risk. But ultimately, you have a choice to make. You can keep 100% of your wealth and economic value concentrated in a system that appears to be on a rocky surface, or you can choose to diversify. As we know, Warren Buffett, Charlie Munger, and many other great investors, diversification sometimes can be an increase in resilience. On top of that, we will continue to see a younger generation choose to trust software over a human-led system. The fact that going into this week, no one knew what the monetary policy of the global reserve currency would be is quite shocking. That is something that feels antiquated and probably something that will change over time. Ultimately, the banking crisis, I do believe, will be solved. I do not believe that the U.S. government, the Federal Reserve, the FDIC, the OCC, and other organizations will allow the banks to fail. That is also true internationally as well. But in order to prevent that failure, to prevent this banking crisis from getting worse, there is going to have to be a hell of an effort where they are going to provide tons and tons of liquidity into the market. That liquidity is likely to be inflationary, and it is likely to increase asset prices. As we look at global liquidity coming from those major central banks, and it continues to increase across the world, asset prices tend to do well. Simple supply and demand economics. If there's more demand, meaning there's more dollars in the market seeking a home, asset prices tend to trend upwards. Now, you have to remember, unless you're a day trader, the day-to-day movements of this stuff probably doesn't matter as much. But we continue to see an extension, a long-term trend of the way the system is set up. We have a fractional reserve banking system. We have a debt-based economy. And as debt continues to increase, as the banks continue to leverage that fractional reserve system, assets like Bitcoin over a really long time frame will probably be big winners. Continue to watch what's happening in the current banking crisis. Continue to watch what the central bank response is. Continue to watch what's happening in Europe and other parts of the world. But ultimately, I think people, and what we see on chain, is that the people who just dollar cost average into great assets and hold them for a long time tend to do well. That's exactly what's happening with Bitcoin. Wallet addresses with 10 Bitcoin or less continues to hit all-time highs. And that just means that millions of people around the world, they're simply Bitcoining and chilling. That's it for this week. I hope you enjoyed this update, and I'll talk to all of you next Saturday.